Okay. Okay, we need to start. Shh. Sit down. Thank you, David. Okay, we need to get started. Okay, so I'm very pleased to introduce a distinguished panel that will be talking about various aspects of systemic risk. Our conversation earlier certainly underscored the importance of this topic. I don't want to take any of the panel's time because I think you're going to want to know what they're saying, so I just want to introduce them all briefly. What I want to say about them as a group is they have a phenomenal commitment to MIT Sloan, so I do want to thank all of them for that. They make many contributions to the school, including the one that they're making today. But first up, we're having Mark Kritzman, who's president and CEO of Windham Capital Management. He was also a founding partner of State Street Associates. For us, he teaches a graduate finance course. He does a great job of that. He has done many things in his long career, but he was a founding director of the International Securities Exchange, and he's been on several boards. Among them are several MIT boards. He's on the advisory board of MIT Sloan Finance Group and the Consortium for Systemic Risk Analytics. I think one thing that's remarkable about Mark is that for someone who keeps a busy day job, he wins enough awards for his research in finance to put to shame most of the faculty at MIT, so you can read about those awards here. And Mark earned his BS in economics from St. John's University and an MBA with distinction from NYU. Okay, let me also introduce the rest of the speakers. So next up after that will be Paul Willen. He's a senior economist and policy advisor at the Federal Reserve Bank of Boston. Paul's research is on household financial management, and he's also one of the world's experts on mortgage markets and what happened during the financial crisis there. He's certainly the person to whom, when I'm thinking about housing policy, I call him, I pick up the phone. He's great on that. He does a wide amount of research and has published in various good journals. Before he was at the Fed, he was on the faculty of Princeton and the University of Chicago. He's also more recently taught at Harvard and at MIT Econ. He did his undergraduate work at Williams College, and he received his PhD from Yale University. Third up, we have Eric Rosenfeld. He currently, I guess, has no affiliation, but he's had a lot of really good ones in the past. So I'll read some of those to you. He was a founding partner of the Quantitative Alternatives, which is a quantitative hedge fund specializing in cross-market volatility trading strategies. Also recently, he was president of Paloma Partners Management Company. Eric has been very involved with the department, also a fantastic teacher, as you'll hear today. Eric received his BS in economics from MIT and also his PhD in 1979 from MIT. And then fourth but not least, we have Roger Stein, who is the Chief Actuary Officer at State Street Global Exchange. Before that, he was the Managing Director of Research and Academic Relations for Moody's Corporation. I think it's fair to say that Roger was involved with many of the most creative and novel innovations that Moody's has undertaken in many years. So he was there for a long time, made great analytical contributions. He's also now a senior lecturer in the finance group at MIT. He's a research affiliate of the MIT Laboratory for Financial Engineering. He's founder and president of the Consortium for Systemic Risk Analytics. So Roger holds a PhD and master's degree from the Stern School of Business at NYU, and he has a bachelor's degree in mathematics and Japanese studies from SUNY Binghamton. So with those brief introductions, actually, you can read more about them. Let's welcome the panel. Okay. So Mark, did you want to?
Thank you, Debbie. It's a pleasure to be here. I'm going to start by reviewing a few new statistical measures of risk that have been developed at MIT over the last several years. So I'm basically talking about statistics. This is the exciting part of the panel, okay? So the first measure I want to talk about is a measure of instability called financial turbulence. And what it literally is, it's a measure of how statistically unusual a set of returns is given their historical pattern of behavior. It takes into account three things: extreme price moves, the decoupling of correlated assets, and the convergence of uncorrelated assets. It can be easily decomposed into two components. One is a volatility surprise, and the other is a correlation surprise. And it has two intriguing empirical features. One is that returns to risk, and risk measured many ways across all different factors, asset classes, et cetera, returns to risk are much, much lower when markets are turbulent than when they're calm. Huge spreads. And the other intriguing feature is that turbulence is persistent. Okay, it may begin because there's some unexpected shock, but once it begins, it takes several weeks to go away. So that means there's an opportunity to actually act upon this. So that's one measure. The second measure I want to talk about, and this was developed with Roberto Rigobon and a couple of other co-authors over the last few years, is a measure of systemic risk called the absorption ratio. And the way this works is that we do a principal components analysis to determine the factors that are driving the variability of returns. And we look at a subset of the most important factors, and we compute what fraction of total variability is explained by these few important factors. So if this ratio is high, if they explain a large fraction of variability, what that tells us is that risk is concentrated, that assets are very unified. And when that's the case, markets are fragile, that shocks travel much more quickly and more broadly. And if these same few factors explain only a small fraction of the variability of returns, what that tells us is that risk is distributed broadly across many disparate sources. And when risk is diffused that way, markets are much more resilient. So this is a very simple, in retrospect, an extremely intuitive measure of systemic risk. It does a really good job of distinguishing fragile market conditions from resilient market conditions ahead of time. And it also turns out that most major drawdowns in the equity markets are preceded by a spike in this measure of risk concentration. The third measure I want to discuss is a measure of systemic importance. And this is something that is of keen interest to policymakers. In fact, the Financial Stability Board spent 2 years identifying the most systemically important financial institutions, and they used fundamental analysis to get at that list. Well, it turns out what you could do is you could look at the absorption ratio, and these factors, their principal components, they're just linear combinations of assets. So for example, if you want to determine how systemically important, let's say, State Street Bank is, right, large bank here in Boston, what you'll do is say, what is the weight of State Street in the first factor, and how important is that factor? What fraction of variability is captured by that first factor? And you scale State Street's weight by the importance of the factor, and you just move down the factors that way, and you sum it up, and you get this measure of centrality. And what it is actually getting at is it's getting at three things: vulnerability to failure, it's getting at connectivity to other institutions or other entities in the system, and it's also measuring how risky those other entities are. And to me, those are the three features of a systemically important entity. So anyway, the FSB came up with their list. They released it in November 2011 based on data ending in 2009. So it really is hard to do fundamentally. There's a lot of problems. There's opacity, there's complexity, there's what you might think of as creative accounting. So in any event, we used our approach to figure out who these systemically important financial institutions were based on prices. The only input we need are prices, right? Ending in 2009, we came up with the same list in a matter of seconds. So it's not to say that one approach is better than the other, but it's certainly to say that one approach is quicker than the other. So let me, on the other hand, it could be a full employment initiative for government employees. But anyway, let me stop there and let the other panelists address you.
Great. It should be on. You can. Oh. Sorry. Technical.
No, we
Well,
have a
the
clicker.
clicker is here.
We just don't have any
is-
slides.
By any chance, is Patsy here? Can you talk without?
I can talk.
Okay. Sorry about
Okay,
that.
well, I can certainly give my disclaimer. So, I actually sometimes have a picture. I used to have a picture of Ben. Now I have a picture of Janet. But I am here today as a researcher and as a concerned citizen, and not as a representative of Janet or Eric or of the Federal Reserve System in general. Okay, there we go. Okay, so I had a little trouble figuring out how to say everything one could about systemic risk in 6 minutes. And so what I decided to do, this still doesn't work. Oh, there we go. Okay. Is to talk, just first to talk to you briefly about my research about the crisis, and then turn to the question of systemic risk. So I'm just going to start by saying that, of course, the crisis, you could say, is one of the greatest failures of risk management of all time. And what characterizes it, I think what puzzling about it and what has been so hard for economists is that what we had was a lot of people who made what we certainly look at after the fact as some terrible decisions. And so these are questions like, why did so many people, borrowers, take out loans they couldn't repay? And then why did investors lend them the money? And so we answered all of this in a paper, and I owe a debt of gratitude to Andy, who I guess isn't here anymore, for making me write this paper, entitled "Why Did So Many People Make So Many Ex Post Bad Decisions?" So I'm just going to give you, as brief as I can, summary of that. And our answer is that the main problem, the main thing that led people to make bad decisions was not bad information. It wasn't that they didn't understand the contracts they were getting into. This is on the side of the borrowers and on the side of the investors. The problem was distorted beliefs about house prices. And so let me give you 2 slides from the presentation and 2 facts from the paper. So there are 12 facts in the paper. I'm only going to give you 2 of them today. And the first one is that investors, our view is that investors basically understood the risks. You will hear over and over and over again that the securities were opaque, that no one understood the mortgages they were buying. Every piece of information you have when you go look at it shows that investors had the information they needed, and they in fact made use of it. So the question is, why did they go ahead and buy all these loans from people who eventually wouldn't pay them back? And so in this is from a paper, actually, a separate paper we wrote, in which we went back to 2005 and we asked, why did investors think investing in subprime-backed securities was a good idea? And what I'm going to show you is ironically, from a Lehman Brothers analyst report, but this analysis was basically the same across all investment banks. And so what they did was to do exactly what we would want them to do, essentially to stress test mortgage-backed securities. And what they did was they did a bunch of scenarios. So there are good scenarios, and then there were some bad scenarios. And just so you understand, that worst-case scenario down there, the meltdown scenario, is substantially better than what happened. Okay, so I've never gotten a big laugh for that particular Anyway, okay, and so what they did then was just to compute the losses. These are on the bonds that were issued in the beginning of 2006. So this is the first cohort of really bad bonds. And what they did was to say, let's look at what the expected losses were under these different scenarios. And so these scenarios at the top here, these are aggressive, and they're really aggressive, right? This is 11% house price appreciation for the next 3 years. So that means this is at a point house prices have already risen something like 70% over the last 5 years, and they're anticipating they're going to rise another 30%. So that's aggressive, but even the baseline scenario is 5% house price appreciation. That's house prices rising more than twice the rate of inflation. The pessimistic scenarios are down there, and the losses on those were small. Those are typical of subprime loans, but just one thing to say, typical of subprime loans, but horrible for any other type of mortgage. These are, we're talking even in the baseline scenario, 10% of the people, 10% of the loans were going to go to foreclosure, not delinquent. These are 10% of the loans would be losses. So that was their good scenarios. Then in the bad scenarios, they have 17% losses for this meltdown scenario. The meltdown scenario, just to give you some idea, that means roughly a third of the loans in the pool would have gone to foreclosure. So not delinquent, but foreclosure. And that is terrible performance. And the point here is, why is this slide so significant? That 17% is basically an accurate number. The actual scenario we had was, as I said, significantly worse, and the losses were worse, but not that much worse. In other words, the losses that they expected, conditional on house prices, were basically in line with the model. So they understood how bad these loans were. And so the question is, why did people invest in loans where it was possible for a third of the loans to default? And the answer is because they thought house prices were going to go up. So this particular analyst report was great because they actually put the probabilities in. And what you see here is they thought there was an 80% chance that house prices were going to rise 5% or more. And if that happened, then you have very, very small losses on these deals. And you can see why someone investing in these deals would think this was a good idea. And so why am I sure that this is the right explanation? I'm sure this is the right explanation because people always have tried to portray it as that there were these hayseeds out there and the financial intermediaries deceived them into buying these securities. But who lost the most money on these securities? The intermediaries who were issuing them. If anybody was going to know that these securities were bad, it was going to be Merrill Lynch, because Merrill Lynch was issuing them. And so you go down this list and you see these are hundreds of billions of dollars. And when they talk about skin in the game, if you take the actual amount that Dodd-Frank insists that lenders hold now, it's something like $14 billion. It would have been. It would have forced them to hold $14 billion of credit risk on their portfolio. Citigroup alone had 3 times that much. So lenders had skin in the game. They had every incentive to find out. And what I'm telling you is they did understand what they were buying. They just got the prices wrong. And that gets me to my point here, which is the problem with, so you say, what do we do as policymakers? Well, we're confronted with this situation where you say, what we have to look for are situations where beliefs are distorted. But the problem is, as economists, we're terrible at that, because the one thing we do not know how to do is forecast asset prices, with all due respect to some people in the room. But fortunately Schiller isn't here. Because people say to me when I say we can't forecast house prices, asset prices, they say, but what about Schiller? And I say, what about Schiller? So Schiller in 1996, when Greenspan said irrational exuberance, Schiller wrote, it appears that long-run investors should stay out of the market for the next decade. So this is in 1996. And then they went on to say, price-to-earnings ratios are extraordinarily bearish for the US stock market. This is from a paper later by Campbell and Schiller, linear regressions, and so on and so forth. Was that good advice? No, that was terrible advice. Over the next 10 years, the stock prices were up 49% in real terms. The real returns with dividends were 6.6%. And that is, so this slide is a little out of date, even if we consider today, so this statement is even vastly more true than it was when I wrote it. We had a massive terrorist attack, 2 wars, and a collapse of the financial system. The annualized total real returns of 4% per year. So what does it tell you? I think what it tells you is that, and I think we're going to turn to the rest of the speakers, we're really going to focus on risk that comes from within the system. This risk, we were hit with a huge, huge shock in 2008. It's not just that the financial system, you could say that the financial system created this by creating the bubble, and maybe you would, But the point here is that what we're talking about are bubbles, and bubbles are the problem, and it's something we don't understand. And I think as an economist, I like to say that we can think of them like earthquakes. So we can't predict when earthquakes will happen. We can't stop them once we've started. And I think you can sort of say the same thing about asset prices. Large movements in asset prices occur far more frequently than theory predicts, but that doesn't mean we can't do something about it. So in the 1989 earthquake near San Francisco was of similar magnitude to the earthquake in Haiti. One of them killed 63 and the other one killed 200,000. So what was the difference? The difference was they had building codes in San Francisco and they didn't have building codes in Haiti. And so we can design structures to withstand an economic earthquake. We can ask the question when a borrower gets a loan, can this home ownership survive a 30% fall in house prices? And then, going to the topic here, we can ask the question, can the financial system withstand a 30% fall in house prices? And I think those are the sorts of things we need to do going forward, and that's what the stress testing is about. It's Debbie pointed, I'm actually presenting a paper this fall on how we did stress testing for Fannie Mae, and you can tell how well that worked. So it's not like we've solved this problem, but that's the direction we have to go. Okay.
Okay, well, given that I have 6 minutes, let me give you the bottom line. I don't know what systemic risk is, I don't know what causes it, and I don't know how to prevent it. So what I'm going to do is give you a little bit of insight that I saw on a previous crisis back when I was a partner at LTCM, where I had a front row seat on systemic risk. On Monday, August 21st, 1998, Russia defaulted on about $6 billion of bonds. What was a little strange was that Goldman had just come with this issuance 6 months earlier. This was their first coupon payment, and Russia missed it. I'm not going to comment on Goldman's due diligence. But what was even more strange were these were ruble bonds. You know, were there no printing presses in Russia, you know, to make the coupon payment? But that being said, on Thursday, you know, given that LTCM didn't have any real Russian positions, on Thursday I took off for a 10-day vacation with my family, and then on Friday morning at 9 a.m., I was waiting for my tea time, I made my most serious trading mistake ever. I called the office. It was bedlam. A risk arb deal, Tellab's purchase of Sienna, which was supposed to close that day, it was at 10 cents, broke to $16. We lost $160 million on that trade alone. Swap spreads, which normally move a basis point, were out 21 basis points. All in, we were down $550 million on the day, 12% of our capital. In our previous 5-year history, we had had 6 losing months, and our largest drawdown was 2.7%. So I shanked 2 into the woods and flew home. So what was it? You know, people have said that, well, this is not too surprising. You know, we lost, for the next 20 days, we lost money every day. We had 40 major trading strategies, and they were all down. What was the common thread? People have said, well, the common thread was your short liquidity and a flight to quality. You know, all spreads go out, so that was your common thread. Well, our largest trade, we were long European swap spreads at 12 basis points, and against it we were short UK swap spreads at 60 basis points. So in this crisis, you would think swap spreads would go out. The two sides would be hedged. Well, swap spreads in the UK, which we were short, went from 60 to 160. Against it, we were long swap spreads at 12 basis points. European swap spreads, they went from 12 all the way up to minus 15. We lost money on both sides of the trades. This wasn't a flight to quality. This was a flight out of our relative value trades. So what was the common thread? What was the common thread in all of our trades? It wasn't caused by the Russian default. Russia was the trigger. But what the common thread was that the holders of these trades were very similar. They were proprietary trading groups, they were other hedge funds, and they had similar risk preferences and tolerances. And after the crisis caused by the Russian default, risk managers said, we need to lighten up on these trades. So as they started taking these trades off, spreads went out further, and they said, we need to lighten up even more. So it almost became this self-fulfilling prophecy where you had this downward spiral as spreads went out, people liquidated more, so spreads went out even more. I guess you should think Andy Lowe's elephant stampede, and I do have a limp, so. I've tried to come up with a physical analogy to, to this risk. And, I have this analogy where I compare the risk that we faced at LTCM with the opening of this new bridge in London called the Millennium Footbridge, which spanned from central London over the Thames to the National Theatre. And on July 10th, 2000, they opened the bridge. Now, this bridge was designed to withstand Hurricane 6 winds. So I don't even know what Hurricane's, factor 6 is, but it's big. So you should think of the winds here as exogenous risk factors. So something like a sovereign default or the World Trade crisis or the Kennedy assassination, a real economic event. Those are the wins. And what we want to do is compare that to what I'm calling endogenous risk, which is risk that comes about within the system. So I too took the Andy Lowe PowerPoint course, only I took the free version. This is not going to be as good. So this is the bridge with people on the bridge, and there was just a light wind that day, Hurricane 0.1. And all of a sudden, with the light wind, people started kind of flowing with the wind, and the bridge began to sway. And so everyone kind of swayed with the bridge, and then they swayed back. And after about 2 hours of this, they shut it down for 6 months to repair it because they were worried that the entire bridge will break apart. This harmonic resonance really is the endogeneity, that the risk is coming not from the exogenous factors, the wind, it's coming from the people within the system. So you should really think of that as the endogeneity in the case of LTCM was everyone sort of liquidating these trades at the same time and the downward spiral that happened. So, given that I'm sort of over my 6 minutes, I'll just say one word on things that we can do to prevent this from happening. So out of the LTCM crisis, dealers tried to protect themselves. So whenever you do a swap now as a hedge fund with a dealer, they tend to put triggers into the swap where if you're down 20%, they have the right to automatically liquidate you. Well, that's systemic. You can see that when losses occur, the swaps get liquidated. That pushes the spreads out even more. That causes other triggers to hit, and you have this downward spiral. So, thank you.
So it's a pleasure to be here. As you can see, we're going in height order. Yes, I am standing. I thought, I actually had prepared a different set of comments. But when I saw the bridge thing and I heard about stress testing and I heard all this, we had a call beforehand. By the way, I didn't know we were allowed to use slides. All right, so I have no slides. That's not true. Debbie said we could, but then I thought we all decided we weren't. So I don't have slides, but I'm going to tell you. I'm going to tell you a bit about some of the slides we just saw. What I want to talk about today is just two things. One is this notion of convergence of beliefs, convergence of models, convergence of other things, particularly around things like stress testing. And the other is sort of what we might do about it. Although we don't have great solutions, we've got a few ideas. And I want to actually pick up on this notion of this bridge. When I teach my course in risk management, I always show this video of the Tacoma Narrows Bridge, which many of you have seen it. It goes like this, and there's a car on it. It's going back and forth, and then it finally collapses. And people like to point at that and say, what a great example of engineering folly. You know, they reached too far. They tried to make it too long. The reality is, actually, that bridge was designed by the same guys that designed the Brooklyn Bridge, the Manhattan Bridge, the Verrazano Bridge, the George Washington Bridge, and so on. It was the same technology. And indeed, that bridge was not long. The George Washington Bridge was twice as long as the previous bridge that used the same technology, previous suspension bridge. The Golden Gate Bridge was 80% longer than the George Washington Bridge. The next big bridge to get built was the Tacoma Narrows Bridge. It was about half the size in terms of length of the George Washington Bridge. And what was interesting about it, there was nothing special about it. It wasn't particularly long. It wasn't particularly in a windy area. But what was interesting about it was at that time, because of the evolution of technology, much of the transport in America had moved away from rail transport and moved towards trucks and trucking and things like that. And as a result, you could use lighter materials because you needed a narrower bridge. You could make the bridge narrower. It didn't have to support a train. And you could also make it cheaper because you could use lighter weight materials. And so they did a bit of extra work, and this actually well-known engineer came up with a slight extension to the current theory, which allowed for the possibility of doing a thinner bridge. And they checked all kinds of the length versus, they did all these different things, and everything was fine. They built the bridge, and about a half a year later, the thing collapsed. Now, no one was hurt. A dog did die on the bridge. His name was Tubby, but no one was actually hurt. But what had actually happened was there was nothing special about the length of the bridge. There was nothing special about the height of the bridge or the direction of the bridge or the shape of the bridge. But what was special was there was a very special relationship, which no one had known about until then, which was that the relationship between the length of the bridge and the width of the bridge and the thickness of the deck of the bridge matters. And the reason nobody had known about that was because you never built a bridge quite that way before. It wasn't too long. It wasn't too heavy. It was just so. And it also was built so that it could withstand, I don't know if it's level 6 hurricane winds, but it was built to withstand a fair amount of wind, 30, 40 miles an hour wind, 30, 40 mile an hour winds, whatever it was. And it turned out it collapsed in a very, very mild breeze. And the reason was that there was this really weird fluttering, it was called, that occurred when the breeze went across in just such a way, across this very thin, very narrow, very thin deck. And that caused it to collapse. So the reason I think it's interesting is because what happened next was particularly, I think, informative and relates a lot to our industry. The very next day, I think it was the New York Times ran an article that said the engineers should have known. And it showed that now with this new knowledge, somebody else did some analysis, and they said they should have done stress testing. And so from that point on, everyone decided that from now on there'd be stress testing. But to me, what was interesting was what didn't happen. What didn't happen was people said, we have to make bridges shorter. People didn't say, we have to use less math when we make bridges. We need more simple models of bridges. They said, you know what, clearly our knowledge is incomplete. We were thinking about this wrong. There's something that we did not realize was going on. Now we've discovered it. We have to extend our models. We have to extend our technology. We have to extend the way we think about bridges and about making them safer. By the way, bridges continue to be built. The guy who designed that bridge won a Lifetime Achievement Award for the contributions he made to engineering. And during the entire period, there was no cessation of bridge building. But what did happen was there were changes in the way bridges were tested. And new stress testing procedures were developed, new standards were created, and so on. And I think of that as a parallel because there's a lot of talk now about stress testing. We talk a lot about, do stress tests work? Did they do the right thing? Jokingly, well, we see how well that worked. It's not clear that it did or didn't. To me, what a stress test is most useful for is not that it gives you a number. Because if you think about it rationally, the space of possible scenarios that one could think about is combinatorially explosive. So the number of scenarios one could try to do a stress test is huge. You need very, very strong priors. The probability that a scenario that I pick will actually happen is effectively 0 because the space is so big. Even if you get the numbers out, it's very hard to order these scenarios because when you order them economically, they don't have the same ordering with respect to a portfolio because of the structure of portfolios, nonlinearities inside portfolios and the way that they behave under different economic circumstances. Conceptually, you can say, would the same stress test work for a portfolio that was short another portfolio? Well, the answer is no. You need a different stress test, right? So there are lots of things that you have to think about when you build a stress scenario. But what stress tests really do a good job of is getting people to think through their organizations and think through the way their portfolios are structured, and also think through their models. If you put a doomsday scenario through one of your models and the model says, not too bad, your model's probably not doing the right thing. You're not sure. It could be that it really is and you've discovered some new rule of science, but the chances are it's not doing the right thing, and it gives you some pause to look at that. If you're an organization and you find that it's really hard for you to figure out which positions are affected by a stress scenario, that tells you that you don't know enough about your positions. You should be able to pull that stuff up really easily. And so there are lots of things that come to bear here. And the nice thing about a stress test that you could get out of almost no other approach that I know is that you can try really wacky ideas out. If you can say it and you can figure out a little bit of math, you can try it out. And the reason I think that's important is that the types of concerns that I have about systemic risk don't relate to an event. They relate to lots of people doing the same thing, just like lots of people walking across the bridge in lockstep. And what happens, I think, when we look at models, when we look at stress tests as an answer or the answer, is that we tend to think about these things in terms of, if I pass the stress test, I'm OK. Or if I did this value at risk level, I'll be OK. And what we're finding is that you really need a much more interdisciplinary approach. And one of the things we've done at Sloan is that we've put together the Consortium for Systemic Risk Analytics, along with some industry groups. It's something that Andrew Lowe, myself, and a few other people started about 2010. And the basic idea is the way that lots of different disciplines can come together, engineering, math, physics, economics, obviously, come together and do speed dating. We all talk about our ideas for 10 minutes and then share the ideas with other folks, and the idea is to really foment new research. Now, unlike Debbie, we believe we should share our knowledge with the world. So if you'd like to come to a conference, we're having one on the 11th of June. It is actually our first public conference. It's going to be right here at, it's going to be across the river at MIT. And it's actually, while seating lasts, you're welcome to join. It's the first, actually, I was being facetious, it's the first public meeting we've had. We've been doing this since about 2011. And there you'll hear lots of different talks on different things. But the thing you'll take away from that is there are lots of different diverse approaches. And our goal is to sort of bring them together, not to get an answer, because, again, I don't think there is an indicator or a signal of systemic risk or a way to fix it. But again, it's, I guess, like an earthquake where you can try to do things a bit differently. And by looking to other disciplines, particularly mathematics, physics, and computation, we find that there's a lot of good answers there in addition to the ones we have in finance. Thank you.
I'd be interested in your perspectives. It's widely recognized that the quantitative easing policy, and I'm not trying to pick on you, Paul, but that it's had a positive effect on the stock market. I think that's pretty much of a consensus. In fact, if you look at it using various measures of quantitative easing, the correlation is extremely high. And it's also, there are a lot of high correlations in economics, but what goes up comes down. There have been 5 instances since the crisis when reserves at the Fed, which is a component of various measures you could use for quantitative easing, have fallen by over $100 billion. $100 billion is more than enough reserves to support the entire US money supply. These weren't policy measures, these were just artifacts of how federal funds were being managed and so forth, treasury financings and the like. Each of those instances with a 100 billion decline in reserves was followed by over 100-point drop in the S&P. Those have been the only 100-point drops in the S&P since the crisis. There also was a very strong statistical relationship before the crisis with these same measures, although it didn't explain as much of the variability in stock returns, obviously, as it has since the crisis. The current Fed policy after the taper is to let the portfolio unwind for a little bit and then sell it off. This would involve the sale of trillions of dollars of securities. If there's any connection with that and stock market returns and other financial market returns, that's, I would view it as a serious systemic risk. So I'd be interested in your perspectives, whether you agree, disagree.
Well, I'm unemployed, so I'm going to hand it over.
I have to be careful, as you might imagine, about talking about monetary policy. So there. No, I think, and I can say what, of course we're thinking about this very carefully and taking it very seriously. And I think I would be careful as an economist. I would be careful about, so the good news about our inability to do asset pricing is that these relationships aren't that stable. So I would just talk about, so house prices, which is the thing I know, is that everybody was sure in 2012, in 2011 and 2012 that because of all the foreclosures, house prices were going to have to fall. And what did they do? I think there's a general principle, by the way. If there's a consensus among economists, you just do the opposite. And in that case, it was right. And house prices just took off, which no one expected. So I would be careful about reading too much into past patterns. But I think so. I will say, I mean, I personally am not involved in managing the portfolio, but I think people are certainly aware of the risks. We were also aware of the risks of falling house prices. So.
There's a question over here.
This is a question for Paul Willen, but maybe the other panelists want to comment as well. So you argue that distorted beliefs about house prices were really at the heart of the crisis. And my question has to do about distorted beliefs about correlations. So Moody's or S&P, I think, relied on a so-called Gaussian copula model. And my question has to do on correlations. My question has to do with kind of the trade-off between mathematical elegance for purposes of tractability and actually the underlying dynamics that we're trying to model.
Actually, maybe Roger.
Well, I mean, I could just take on one brief.
Okay,
let me just take one brief,
joking.
just brief. While you're waiting for sensation to come back, although I'm not sure why you need it to talk, but just on your question is that actually, when you talk about modeling mortgage performance, in some sense, if you think about, what do you need the Gaussian copula for? In a sense, what you need it for is when you can't put structure on the correlation. In the case of mortgages, of the underlying mortgages, it's very easy to place the correlation because at least we know two of them, interest rates and prices. And you know the interest rates and you know the prices, so essentially you can do a regression, and that gets a big part of the correlation across the assets. And everybody who did mortgages knew how highly correlated these were. That's why they were able to predict it. I think where the failure was in modeling the CDOs, which was done with the copula, where they treated 90 different triple B tranches from 90 different deals as if they were 90 different corporate bonds. And they weren't. They were 90. It was like, it would be as if you bought 90 different S&P 500 index funds and thought you were much more diversified than with one. So, yep.
Do you want-
Am I on? Oh. So I was going to say, I think in general, when I think about correlation. I think about correlation. I think about the relationship that economic factors have to different things. I guess when I think about it this way. When we're talking about extreme tail events, really rare events, by construction, we're talking about things for which we have either zero or very little empirical data. All right? So whether we're stress testing, whether we're relying on a structural model, whatever we're doing, somebody's making some big assumptions about what happens in the tail. And it turns out that in the tail, a lot of those relationships just change. And so, without saying this model is right, this model is wrong, it's almost certain that the way things behave in normal or even very bad times is not how they behave in a crisis. So one of the things that happened, for example, during the housing crisis was homeowners, particularly those who were buying investment properties, learned how to default. There's some studies that show that the more folks in your neighborhood defaulted, the more likely it was that you would default. And it wasn't just a neighborhood thing, it was a proximity. If your neighbor across the street defaulted, you were more likely than if your neighbor down the block defaulted. That was a new behavior. It had never been seen before. It's not something we expected, but it increased default rates. Now, that's not something that has a lot to do with any models I might have built about the relationship between home prices and mortgage performance, but it was a factor in the modeling. And there are lots of things like that almost in every crisis, in hindsight, you could see there was an extra little thing that, if you'd only realized this one thing, would have changed things. And so I think that, my view has evolved to this one where when I look at tail risk, extreme tail risk, not everyday tail risk, when I look at extreme tail risk, I basically acknowledge that, look, I might say there's a 1 in 1,000 probability. Somebody else might say 1 in 10,000. We could argue all day. Neither one of us can prove who's right. It's really, at that point, it's a subjective view.
Yeah, George.
And I'm a quant, by the way.
Yeah. Let me add something, too. So I think Roger's point earlier is that when models or methods fail or are inadequate, it's not that we retreat from science. We should try to do it better. And I think we learned a lot in the crisis that a lot of the tools we had just didn't do a good job. Correlation is not that useful for many applications for the reason that it does not distinguish between important assets and unimportant assets. So high volatility assets are much more important to risk concentration than low volatility assets. So not that I want to plug my own measure, the absorption ratio, but it does take into account the relative importance of the assets when it's measuring risk concentration. So I think that's an example of trying to do things better rather than retreating from quantitative approaches.
There's a question back here.
A lot of the times when I think about systemic risk, I think a lot about the pre-2000, 5 decades before, where we saw a lot of risk related to typical cycles, related to overproduction and overinvestment in real estate or in assets. I'm curious, what kinds of systemic risks do you think about or think we're looking at that maybe are a little bit unprecedented? Things related to maybe technology and innovation and productivity increasing at such a rate of pace that eventually it starts creating structural unemployment problems because so many people are being displaced by the technology, or wealth concentrations that create tensions with the middle class, or things like the unfunded social systems, $110 trillion liabilities for Social Security and Medicare while we keep increasing programs that we know we haven't made a way to pay for yet, or global tensions. I mean, there seems to be a lot of things that we just haven't faced before in the past generation that now are on the horizon, and I'm curious how you think about that as well, and what things you think are most important to incorporate into systemic risk thoughts.
Well, I'll give you a little bit of thoughts, but I still am unemployed. So when I was trading back in the 80s, we had a number of crises. I mean, clearly the crash of '87, but that was just, a few days. It wasn't, the end of the world, whereas Lehman was the end of the world almost. And I think part of that was that markets tended to trade in silos back then, that convertible traders didn't really talk to bond traders or even equity traders for that matter. So all the markets were kind of siloed off. But now everybody has a Bloomberg. And all these markets, you know, swaps here, forwards, futures, they're on every Bloomberg, and people drift into other areas when they think something is cheap. So, you know, given globalization, I think that markets, for one thing, can withstand shocks, but in large shocks, it's almost like a rubber band, you know. In a small shock, the rubber band goes out and eventually comes back in. But in a major shock, the rubber band breaks and you're off to the races. So, you know, I think that by having globalization, it's helped, but it's also hurt. So I don't know if that's...
I'd like to make a couple of observations and receive comments not from any particular panelists, but across the panel. First, there was a slide very early on, 3 bullets as to what caused, at least in part, the housing crisis. The first 2 had to deal with consumer behavior, and the third had to do with the institutional behavior. I would say that the consumers who may have known everything that was claimed could not have been in a position to do what they did if the institutions who knew everything that they knew didn't make the loans available. Behavior is at the core of a lot of things, maybe most everything. And with respect to the traders that were responsible, or the lenders, or in the institutions for making these loans, if you look at how they are paid, what motivates them? If they see to the left and to the right traders or loan experts that are making loans and getting wealthy, and they know what's going on and know these loans are risky and should not be made, but the guy on the left, the guy on the right is making them and getting wealthy doing it, they have to do it too. And from an institutional respect, if the bank on the left and the bank on the right is doing it, they have to be in the game. And what needs to get done, if you're one of these banks or one of these traders, is knowing when to pull the plug so that you can stay in the game as long as you can stay in, making all the money, satisfying shareholders, satisfying your wife or your husband, but pulling the plug before it's too late. But as we know, when we try to pick stocks, you can't always time things. So if you accept what I'm saying, at least in part, you've got to get to the source of the behavior and decide how the institutions address the problem so that the behavior is not rewarded, so that the problem doesn't exist, or at least not to the same degree.
Aimed at me. That was my slide. I was hoping someone else was going to. So it's a good question. I think one of the things that ways you can think about this is that you know, we used to talk, and we have all kinds of prominent economists who, you know, in the early 2000s talked about how the U.S. had the world's best financial system. It was this optimal combination of just right regulation and incentives and all that. And of course, that didn't, no one says that anymore. And, but I think it's, in a sense, there was some way in which the system was so efficient. So you had a lot of borrowers who wanted to borrow, and you had a lot of investors who wanted to invest. And the system was so efficient at matching them up. I mean, that's what the system is supposed to do. I mean, we don't, in some sense, you know, the capitalism is based on if people want to do something, then we let them do it. And I think the system worked great. In a way, you could say 50 years ago, the primitive mortgage finance system we had, it might have stopped it, but not in a sense for a good reason, but just because it was crude. But the system was so efficient that it was able to move money from people who wanted it, from people who had it, to people who wanted it. And so I think that's probably right, that, that you know, the system was, in some sense, was a system that works fine, It's sort of like when your immune system turns on you. It's something that works great most of the time, but every now and then, you know, when you put the wrong stress on it, it did exactly the wrong thing. And so I don't, you know, the question is, how do you design a financial system that moves capital from people who have it to people who want it most of the time, but then stops some of the time? And I guess that's the challenge of regulation.
I think, Roger, you had a key insight that I'd never heard expressed before that reads on the herd behavior. Perhaps bad behavior, smoking, taking out loans you can't afford, making loans you shouldn't, not paying back loans is destigmatized if your neighbors are doing it. And that could explain a lot, and I'd never heard that insight. So am I hearing you right?
That wasn't my result. There's actually some papers on this that have done that research, and that was the conclusion. Yeah, but I mean, it's certainly very intuitive. But the key thing there was not so much that it's more likely you do it, but that it became acceptable to do, which is a different. There's a ergodicity there, right? So, you know, up to a certain point, you may be more likely to do it, but at a certain point, it becomes okay, and then it's much easier to do. And I just want to follow up on one of Mark's points, which is that I think one of the traps that we sometimes fall into is we think of models as being something more than models. You know, I think of models as frameworks through which I can ask and answer questions and make predictions with caveats. And I think sometimes a lot of the other stuff gets lost and it becomes about make predictions, period. And I think that there's a real role for, you know, judgment in applying the models and understanding them deeply as opposed to just turning the crank. That's important. And I think that, you know, I have friends who work in weather forecasting, and, you know, if on their computer screen there's a hurricane, they don't, you know, expect to be wet in their office. And I think sometimes we expect that kind of immediacy out of the financial models that we use. So it's something to keep in mind as well, I think.
Okay. Well, unfortunately, I've been told that that was the last question. So please join me in thanking our panel.